Hello everybody, my name is Chris Kimble, founder and CEO of Kimble Charting Solutions. Thanks for taking the time to visit with us today. I want to share some actionable ideas with you. We'll just kind of dig right into it. One of the things I want to make sure in discussing with everyone is that, just to kind of let you know about our shop. We're not a bull or a bear, we're just bullish on market opportunities. We believe if you're bullish or bearish, that's nothing more than a psychological state of mind, and we're more interested in strategies. One thing I have fun with is the name of our company is not Kimble Charting Problems, it's Kimble Charting Solutions, and when we turn on the news, it's just pretty darn easy to see a lot of issues with our election and things going on. But this is my 36th year in the business, and I've never been more excited about the opportunities that are out there, the tools for each one of us, the solutions that we can provide, and the potential to be rewarding to your portfolio has never been greater, in my opinion. Today, real quickly, we'll look at who we are, what we do, and how you can use our research to make money. One of the things I wanted to start out, the beginning of this talk with is what we liked at the beginning of the year, and what we like pattern-wise, and what we did. So this is a IBB, the biotech ETF. We saw a rising bearish wedge taking place, and then as soon as support was broken here, we went and shorted biotech, and this is back in January by the purchase of BIS, which is a 2x inverse biotech ETF, and we picked up double-digit yields, and then as it started to fall, we took profits off the table and closed the position. Another pattern that we liked early in this year was transports that had been hit very, very hard. You'll notice it was a long-term rising support line. Here was two different support lines and a resistance coming into play. Once that was broken to the upside, we purchased IYT, and we walked away with that with a double-digit return as well. One of the things that we really like is we've written a paper that you're very welcome for us to get to you. It's not a membership paper or anything, but it's essentially how to turn a hockey stick, or when you see a hockey stick, how it can really enlarge your portfolio. And what we're speaking about is fear. And so this is the inverse fear ETF XIV, and you'll notice that earlier in this year, in January, XIV again is the inverse to fear. As fear was rising, it was compressing XIV. XIV was on a rising multi-year support line. You'll see it was breaking resistance, and we bought XIV, traded back out of it for another double-digit yield. So I'm just showing you these things to see how we work, what we like, and what we look for. So I'm a student of Sir John Templeton, and he was my mentor, and one of the things I just always kind of want to reiterate is his 4 stages of bull and bear markets. That bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die on euphoria. Our strategy is called TBNM, which stands for tops, bottoms, and no middles. So we're really looking for the guy on the left side, the pessimistic face. And I want to just kind of remind you of this sequence, because if you work, or you're retired, or you're at a sporting event, or wherever, when pessimism is out there, you're going to see a lot of your friends and maybe your own face in the mirror that looks like the guy on the left. And then on the flip side, when things are really going right, you see people at work that are really excited about certain assets, and they start bragging about them. That may be a time that they could die on euphoria. So what we're trying to do is expedite and really look and dig into these two emotions on the both extremes, and to try to help find patterns for you to trade off of. So I want to kind of look at right now things that we're very excited about, or that we're looking into. So I'm going to show you 4 or 5 different charts. I just want you to look at the pattern, and we'll disclose all of these at the end and what they are. But you'll notice that in whatever this asset happens to be, it looks like an inverse head and shoulders with a test of the neckline. And this is a current chart, so this chart would be pressing against the neckline as of right now. Now you're going to say, is Chris just showing us the same chart again? No, this is actually another hard hit asset since last summer. It's also up against the neckline potentially. Same thing in this one. So we're going to discuss later on 3 potential bullish inverse head and shoulders that are pressing near neckline resistance that could end up being great trades. Here's another one, a 50-year chart that looks like a giant head and shoulders topping pattern, and now it's very near a support line that's bounced off of in the last couple of months. We'll discuss in a little bit the implications of what this chart is, what it was, how we traded it, and what you do now. Here's another 20-year chart on an asset that you'll see is on a rising 20-year support line and is caught also in a jam up against multi-year falling resistance. What is this asset? What's its implications on a macro basis? We'll discuss shortly. Here's another chart. This happens to be a stock, and it's going to be a stock that almost every one of you know. Potentially we see a descending triangle pattern roughly 2/3 of the time. When support is broken, this asset will fall, and it will fall to the degree of the measured move. So whatever this happens to be, if it would break that support line around the 90 level, it could trade to about 60. So that could be a 30% haircut. So we'd want to be aware of that pattern. And here's another one of over a 90% decline in the stock, potential bullish inverse head and shoulders, potential neckline. What could you do with it? What sector is it? What trades might you take? So we'll discuss that just in a little bit. So we're trying to do really several things for people, everyone. We're trying to look at the big picture, and we're also trying to look at macro swing trades on a shorter time frame. We have multiple products, and I just want to say, in case any of you get you need to run, that if you need to get a hold of us, send us an email at services@kimblechartingsolutions.com. That's services@kimblechartingsolutions.com, and we'll come back to that, again. But one of the things that we discussed with our customers a year ago in a webinar is what we call the 125/5 indicator. So if we looked at this long-term chart of the S&P and you just threw a dart and it landed anywhere on this long-term chart, one of the interesting things is when you look at the total returns, wherever that dot landed, your odds in 5 years later, wherever that dart hit this chart, that's almost 70% of the time you'd make 40% on your money. And then in the 10-year time frame, you could almost 80% of the time double your money. So the market's been a great place to be, going back to the 1920s. But when we talk about overbought momentum, successful rallies, what our 125/5 indicator is nothing more than this. What happens to the S&P after it's made 125% in a 5-year window? So each of these red dots represent a time that the S&P accomplished that. And so one of the things that really caught our eye is if you happen to throw a dart and be unfortunate and hit one of these red dots after the 125/5 indicator went off, the average 5-year return is a negative 20%, and the market's only rallied 19% of the time. So in other words, 80% of the time it didn't have a net gain. 10 years later, in the upper left shows the average gain is 100% in 10 years. After the 125/5 has went off, the average gain is a total return of 9% in 10 years, and only 30% of the time it's positive. The flip of that is 70% of the time it's not. So this is not a market timing tool, but this is to help from the big picture analysis. And so if you're a buy and holder, this is a frustrating statistic. But it doesn't mean the current trend has to end, but you need to be aware that after the market has done so well, it typically takes a breather. This is not a macro indicator or anything like that. This is just about what are the odds of returns when certain things, take place. So if you're into swing trading or being more active, this statistic or this table in the lower right would actually pat you on the back and say, guess what? This environment is in the right place for that type of a strategy. So again, this is not to try to be market timing. This is not a bearish signal. This is just a reality check that when the market has been hot, it typically cools off. So one of the things that I always made a promise to Sir John Templeton. Sir John said that outside of the Bible, his favorite book that he'd learned the most from was this book called The Extraordinary Popular Delusions and the Madness of Crowds. And John got this book for me 20 years ago, and it's one of my treasures that he signed it in the mid-90s. But in the late 90s, Sir John said, Chris, here's a few reasons why I think at best the market will be flat 15 years later. I'd been a financial planner at that time for almost 20 years. I didn't care for what he had to say, but I understood what he had to say, and that's why we're doing what we are today, because of some of the overvaluation and the ideas that he shared with me in the late 90s. He's been really accurate with that. What's interesting is if you take the S&P 500 and inflation adjust it, it's at the same price as it was in 2000. So all of us are investing monies to try to beat the cost of life, beat the cost of living, and it hasn't had a lot of success on a net basis since 2000. So I'd encourage you, this book, to go get and read. It will change your perspectives, I can promise you that. So one of the things that Sir John was talking about before he passed away is he felt like the market was at one of the highest risk standpoints in his career, and he didn't mean it from a valuation perspective, he meant it from this. And this isn't picking on Donald Trump or anything like that, it's what we're discussing is look-alike patterns. Sir John said that the world has just become one giant, essentially, correlated asset from the stock market perspective. And so he felt like that we were all facing a risky market because diversification wasn't just the friend that it used to be, for us. So one of the things that we share each week in one of our reports called the Global Dashboard report is the look at the key stock indices around the world. And you see that the top line being the Dow, the S&P, and mid-caps. They're all very close to last year's high, but when you start shifting to the middle level, being the Russell, the NASDAQ, and the value line geometric, where then you go to Europe with Germany, London, and France, you'll notice they're all in 5 to 6 year uptrends, and so that hasn't broke. But the lower tier, from the 4th one to the 9th one, they're all created a series of lower highs over a period of time. And so we're facing some really key resistance levels to see if we can break the 1 year trend of lower highs and lower lows. But the thing is, just like the look-like picture, with Donald, is we could almost change the majority of these, the names of the labels, and it'd be hard to separate them. So big, important resistance test on a global basis taking place right now. And obviously, if one of these would break to the upside, it would be very bullish news across the board. If they would turn weak here, it would be a very concerning message, as well. So one of the things that I want to kind of share is this is a key stock market in America, in the States. And so you'll notice from 2000 to 2007, there was a solid rising trend, and then there was a 1 year series of lower highs and lower lows. And on the third attempt, essentially, to break out of the blue arrow, it failed, and then a lot of selling pressure came in. So I'm not going to try to compare 2007 to today from a macro or financial perspective. I believe that things are different. But here's something that's not different than 2007, fear and greed. Markets are driven by billions of free-thinking people, and so I just kind of want to show that even though the time is different, the patterns don't look a lot different at this time. So again, we have another solid uptrend. We have a series of lower highs and lower lows. This is a current chart. So it's very important where this new blue arrow that came in the upper right, for buyers to come and break out of there. Because if not, when we look at the global lack of diversification and the high correlation, and just to let you know, this chart in the upper left, you'll see I just now exposed it as the NYSE Composite Index on a weekly basis. So a really important test to try to not repeat some of the pattern that we saw in 2007. And I'm not bringing up 2007 from trying to say we'll see the same type of a decline. That's not the point. We're just looking for pattern replication and duplication here. So really key price point where the NYSE is right now in the upper right. So now we're going to go back to the charts from the beginning of the presentation. The first chart that we looked at was the bank index. Very few times has the market made solid rallies to the upside without the banks going along for the ride. So could the bank index be creating an inverse head and shoulders pattern with a neckline test, right now? It's possible. So what happens at this resistance line is going to be very key for a very important sector in the economy and banks in general. They've lagged the market for a while. If a breakout would take place here, it would send a positive signal. This would not be a place that people would want to see weakness take place after. Now this would be the third set of lower highs. The next chart that we saw earlier was the Russell 2000, similar looking pattern. So a breakout to the upside would be a very positive move. This would not be a place we'd want to see weakness or reversals take place. Dow Transportation, we shared that we had played that earlier in the year. So you can see a similar pattern taking place here, another potential inverse head and shoulders. So these charts that we just looked at, they were some of the worst performers or the weakest sectors since 2015. So it's just really interesting to me to see the ones that had fallen a lot further than the S&P that are testing and potentially creating bullish patterns. So the thing that we would not want to see is any failure moves up against this falling resistance line. The long-term chart that we looked at, that I mentioned earlier, is 50 years ago, is a Thomson Reuters Commodities Index, and we started sharing 2 years ago in July with our customers that commodities could be in July of 2014 at the right shoulder of what I have found to be one of the largest head and shoulders topping patterns potentially that any of us could find looking in the rearview mirror. So as I said to my members, I have a bias here that I really don't want to see that neckline go, because the measured move, if this pattern is correct, if support would break, the measured move would suggest that commodities would fall another 50%. Since the right shoulder in 2014 in this pattern took place, the NYSE and some of the really broad indices have struggled to move higher. And so it would be great from a consumption or a reflection of consumption around the world to see commodities go up. They bounce nicely off the support line. We really want this support line, in my opinion. We can always win trading battles, but this would be a war that I would be concerned that we wouldn't really want to go into if commodities would break this 40-year support line, in this index around the 350 level. So very important pattern here, and you can see in 2008 or 9 where it hit support and rocketed up. I think it'd be good for the global community and assets if this commodity piece would keep moving higher. One of the things that's interesting from pessimism, this is the 5-year performance of the CRB Index. And I apologize, I typically look at it longer than the last 12 years, but just to let you know, over the 5-year rate of return, the CRB is down 46%. This is the worst 5-year return in its history, and so somewhere in there is beautiful opportunities. Even if you say, well, Chris, I really don't trade commodities, I humbly believe what this index does going forward will have a large impact on some bond trades that you might do, some currencies, and some stock indices. So even if you don't trade some of these commodities, I think what happens here is really, really important, folks. One of the other long-term charts that we looked at was copper. This is copper on a monthly basis. You can see that around 83% of the last 20 years, copper has stayed inside these this rising channel between support and resistance. And you can see over the last 5 years, it's created a series of lower highs, and so it's caught in this really tight jam. So I think, from a global macro perspective, this zero interest rate, environment that we're sitting in, we'd like to see copper push above that resistance line. So in its own little way, it's formed a pennant pattern. It's stuck between 20-year support and 5-year resistance. I'd want to follow the move in either direction this takes. From a bias perspective, I'd like to see it move higher, because Copper has been signaling accurately that the global community is not growing a lot despite the greatest efforts of the central banks to provide fuel to the economy. I think that's one thing that's kind of concerning. They've poured a bunch of money into the engine, and the engine's just not really percolating very well. And so if I was a mechanic, I'd say it's probably not the fuel, if the engine has a problem itself. So what are the non-benefactors of this huge decline in commodities has been, you can see what's happened to Joy Global. Essentially had a 90% decline, but here's kind of a pattern I want you to potentially look at in this oversold complex. Is potentially an inverse head and shoulders in Joy could be forming with a right shoulder potentially complete with a neckline up above. And because this thing's been beaten up, so hard, that if you would take the distance from the head to the neckline, if the neckline would break out, and so you would flip the measured move to the upside, it's amazing that that measured move would suggest that Joy Global, on a neckline breakout, its measured move would be at least 150% gain. So this is a really hard hit asset that we've been sharing with our customers for quite a while, and what it does at that neckline could be very much an opportunity if it breaks to the upside. Most of you have probably heard of some company called Apple Computer, a small company that's out there. Essentially, there's a possibility that's forming a descending triangle. A descending triangle is characterized by a series of lower highs and flat bottoms. This pattern, roughly 2/3 of the time, suggests that the asset will fall in price. So we all know how important that Apple would be. Buffett really hopes that this pattern breaks or fails to do its traditional message, and then it breaks this upper level resistance. That would be very positive, for Apple. But if Apple would happen to break that lower support line, the measured move would suggest that Apple would trade, into the low 60s. And so probably not something that a lot of people want to see, happen on a big picture basis. But this is an easy one to chart, so I suggest you try to keep a watch on Apple in this pattern. And if that support level would give way, you could see probably quite a bit of selling pressure, run into the market. One of the things that's kind of interesting on the metals situation is the rapid reversal and positioning of net positions towards gold. If you go kind of to the lower right of the chart in 2016, you'll notice that there's just a ton of people essentially short, or in other words, in the last, this chart goes back 7 years, there was almost the fewest number of people bullish gold in that lower right corner. Now, if you go back to 2011, you can see how speculative people were at the high. So it's really amazing to me in my 35 years in this business. I don't think I've seen something switch this much, that the net positions went from such a bearish to a very bullish overall position taken by people in what, 5 months. I mean, it's an incredible shift. And so this is a look at gold. You can see it's continued to make a series of lower highs. This chart was sent out to our metals members. We have a report that comes out each Wednesday that we call our metals report that focuses on gold, silver, copper, and the mining stocks. And so you can see that gold is in this sideways pattern since the middle of 2014. It just went back and hit its late 2014 highs. There was a triple resistance point, and it's edged below a bearish rising wedge at that number 1 up there. So with the combination of that very large aggressive long position and this break, I think people got to be pretty careful right here. One of the things that Sir John focused on in the late 90s was the message from junk bonds, which junk ETFs, everybody, weren't available at that time, but the fund in the upper right, which is the PIMCO High Yield Fund, and I think it's PHDAX, started turning down in the late 90s, and it was sending a message to the broad market that the internals were turning weak. So one of the things that we look at is in the upper left is a PIMCO High Income Fund. The ETF is PHK, everyone. PHDAX is in the upper right. And then there's a PowerShare senior loan portfolio in the lower left, and the lower left, in the lower right is JNK. It's kind of amazing to me that these tools, all 4 of them, are up against the 38% fib resistance level at the same time that all the global stock markets are up against falling 1-year resistance levels at the same time. So we really try to watch these pieces on a macro basis. Bullish message from the sector would be breakouts above the 38% fib. If these would turn weak, it would send a very cautionary message as the world indices have created this series of lower highs. So we're really watching this sector pretty darn close, everyone. One of the things is a good friend of mine, years ago, he said, Chris, you're essentially my 30-second advantage, and I wasn't bright enough to figure out what he meant. And he said, well, Chris, I can see I'm a very, very busy person. I can see what you want me to do in 30 seconds or less, and I can get it on my way. So we try to be efficient. We don't try to inundate with just tons of information. We try to show you our analysis on stock patterns so that you can go have fun in your life, whether it's your job, your activities, you're retired, your grandkids. So we're not trying to consume a lot of your time, reading our research. So here's one of the chart patterns that I think we ought to pay attention to because it represents 1/6 of the world's population. This is the Shanghai Index, from China. And one of the things that I'm watching real close is this an important kiss that's taking place? One of the things that we played around, or I did, with years ago, and came up with the idea of the Eiffel Tower pattern. And so, in other words, what we tried to visually explain is if you see the left side of the Eiffel Tower on a support break, or if you have experienced that left side, you could also experience the right side of the tower. So you see the Shanghai Index, there was an Eiffel Tower you could almost fit in between 2006 and 2008. I don't know that we have an Eiffel Tower taking place right now, but we did see a heck of a run from 2014, on up. That was much greater than the S&P 500. But here's whether you trade this area or not, we just discussed commodities. Obviously, 1/6 of the world's population is a consumer of a lot of goods and services around the world. This is one thing I want you to watch what happens right here. You'll notice that it's essentially, there's some horizontal lower channel lines that have been broken. It has kissed the underside of that channel, tried to get back above it lately. But this is a key intersection to me, which is around the 3,000 level, that we would not want to see the companies or this index in China start turning weak, here. From a world perspective and consumption, you'd want to see a breakout. If we saw further weakness here in the Shanghai, it could probably ripple into the States, very easily and through Europe. One of the things that I wanted to show that or share with you is this interview from StockTwits. And if you're really bored or you have insomnia at night or something like this, go to soundcloud.com/StockTwits and then Chris Kimble, and you can hear just some more of our philosophy. This is nothing about charts, just some of my experiences and what we think. We've had some good reports back, from this. So this is completely free. You can go and sign on and listen to that, at your own discretion. So we just wanted to wrap up today with the idea that we have 3 different research products that are less than $1 a day. And so we have our global dashboard report that tries to cover the U.S. indices, also the international indices you see in the upper right, commodities and currencies. This is sent out once a week. We call it our weekly report. Again, this is called the Global Dashboard. That's $29 a month. We have another report that we call Sectors and Commodity Sentiment Extremes, to where we cover the main S&P 500 sectors, the 9 different sectors, and all of the commodities associated around with it. It's also a weekly report, and it's less than $1 a day. It's $29 a month itself. And then thirdly, we have a metals report that covers gold, silver, copper, and the miners, and it again is $29 a month. Surprise, surprise. But we do have a package that we call a triple play discount, and so if you happen to buy 2 of these, you essentially get 1 for free. So the 3 combined, we call it the triple play program. It's $57 a month, and so you get each of these. You get the metals reports each Wednesday, and you get the global dashboard and sectors reports on Thursdays. I do want to say that from a risk perspective, we know that our investment in the investing world, there is no such thing as no risk, but there is from an investment within us, a no risk investment. Our best service comes with a free trial, and we call that our premium membership, and that's daily research. And so that's getting information from me daily, oftentimes also on weekends, that we've tried to share ideas with people. The first Tuesday of each month we have a webinar that takes place for premium members only. So you can try this premium membership that's risk-free. So it's the risk is there is none. Remember when Ross Perot ran for president? He always talked about lifting up in the hood and looking underneath. What we're just trying to do here, everyone, is let you see the premium members. They get the weekly reports plus the daily. You can go and try this, and there's just no obligation. and the onus is completely on us. And if I was a customer, this is what I would want, is to be able to look at research. Let me just drive it for a while and see how it fits. So I think, you know, Reed was going to put a link that you could sign up for the free trial today if you wanted. I think it's in the lower right. You can click on it and go from there. And there's no strings attached to this whatsoever, so I appreciate and I'm humbled by anyone giving it a try. So you can click on that link, or you can go to services@kimblechartingsolutions.com or call the phone number directly. Excuse me. So another thing that I wanted to also extend is each month, as I shared, we do what we call our Connect series and connecting with our premium members. That we do the first Tuesday at 5 Eastern each month. That if you would like a copy of the last 2 webinars that we've conducted for our premium members, just shoot us an email. You don't even have to do the free trial, but if you'd like to see the charts that we shared at the beginning of this month or the month before that, just send an email to services@kimblechartingsolutions.com and say, please send us your Connect series webinar, and we'd sure be happy to.